Welcome, everyone, and thank you for joining us today. I'm Troy Pospisil, CEO of Ontra. We build AI-powered legal and compliance solutions for the private markets. And I am thrilled to have with me one of the most respected voices in private equity, Hugh MacArthur, who leads the global private equity practice at Bain Company. Hugh, welcome and good to see you.
Troy, good to see you, and thanks very much for having me on the show.
Well, today's conversation is one I've been looking forward to for a while. If you've spent the last few years in the private equity industry, you are keenly aware of the feeling that many of us feel every January. There is a collective sense that this is the year deal activity is going to rebound, exits are going to pick up, LPs are going to get their distributions, and then every year something seems to happen. In 22, it was rising rates. In 23, it was Silicon Valley Bank. In 24, it was election uncertainty. In 25, it was Liberation Day. And I'm sure I'm missing many other big news stories that contributed to this. But we're here today to explore where we are now and what does the data say. So to help answer that, Ontra just published our inaugural market index report, a first of its kind leading indicator of private markets deal activity. Ontra processes over 1,000 non-disclosure agreements every single day on behalf of over 1,000 private equity firms. So we have a really unique forward-looking signal. NDAs are executed at the start of every transaction, and it's a very clear signal of deal intent. And historically, what we've shown is NDA volume predicts closed deal volume with very strong correlation. And as I'm sure everyone is aware, Bain recently released their much anticipated annual private equity report. And so I can't think of a better person to help us put that data into context than Hugh. So Hugh, let's start at the beginning. Maybe help us fill in the gaps on what we just talked about. Just set the scene for us. How did we get to where we are today over the last few years? What is all the context? Valuations, debt loads, dry powder, interest rates, LP allocations, all of it.
It's a big question, Troy, and I, like you, feel like it's kind of Groundhog Day every January, where we're going to have an explosive amount of deals and lots of portfolio companies are going to be liquidated and lots of cash is going to come back to LPs. In the last few years, it just hasn't been that way for all of the reasons that you cited. And this year we had an initial wobble out of the gate with kind of, does anybody know what the terminal value of a SaaS business is anymore with AI, with that article that was a quote unquote scenario that was put out into the marketplace. So there's a lot of noise and a lot of confusion. And if you take the long view here, I think the interesting thing to me is that we had a decade long period of zero central bank interest rates from 2012 to about 2022. And during that decade, folks were able to borrow money very inexpensively. GDP growth was very strong and predictable. Prices increased every single year, and multiple expansion was essentially built into the private equity buyout equation in a very material way. And this was an incredibly anomalous period in history. We've never had a decade of zero central bank interest rates, and yet it began to feel normal. And the returns were good in the buyout industry. The prices were going up. People were recycling capital in a very predictable way. And I think we all kind of fell into this notion that somehow this is the normal. And then, of course, 2020 happened and we wound up with a global pandemic, sending people scrambling to their portfolio companies and their balance sheets to try and understand what the impact of that was going to be. And then in 2021, 2022, we had unprecedentedly rapid increases in inflation. After that, we had an 18-month run-up of about 500 basis points in interest rates. Then, to your point, we have tariffs and other macro issues, shooting wars going on. So we had this bumpy 5 or 6 year period of lots of big tumultuous things going on that caused people to go back and say, well, is what we underwrote still true? How do we actually get the value? All of which didn't impact pricing very much because only things that were what I call proof assets were coming to market. And by that, I mean, it's recession proof, it's inflation proof, it's macro proof, whatever you're worried about, it's like perfect. And so most of the pricing continued to go up during this period of time. And so what all of that did was it actually masked the maturation of the buyout industry in particular. We are now in a competitive, mature industry. It is about a $5 trillion AUM industry now. That's triple what it was a decade ago. And we're in a period of time where Interest rates are real. They're probably not going back to zero again. I don't know anybody forecasting that. The amount of dry powder out there is substantial. It's near an all-time record, about $1.3 trillion. So there's plenty of dry powder to get deals done. The credit markets are open. We do not have a banking crisis. We have a large, healthy private credit market. We have for big deals, we have syndicated loans. The banks are lending in the big deals. And so there's nothing structural out there that's actually preventing deals from getting done. Now, what have we seen in terms of the data? What we've seen in the data is that 2025 was close to a record year in deal making. We had over $900 billion worth of transaction value. Now, that's a little bit misleading because the number of deals by count was actually off 6% in 2025 versus 2024. So that means we saw a lot of large deals get done. In fact, about 11 deals in the United States alone that were over $10 billion accounted for most of the growth of 2025 in deal value versus 2024. So we had a few very large deals getting done. The interesting mirrored reflection of that is that we saw the same thing on the exit side. We saw over $700 billion worth of exits being done, which was the second highest year ever. But the volume of exits in terms of number of them was down 2% over time. So again, if you were part of, say, the Medline IPO, where that was $7 billion came off the table, you're pretty happy as an LP and as a GP. If you didn't happen to be part of one of those big deals, the number of transactions went down. And the result is we still have a liquidity issue that is now moving into its fifth year if we don't see big changes in the industry. That is, in my view, the number one topic in the buyout industry is this liquidity issue, which is driven by lots of portfolio companies, about 38,000 globally, we estimate, 32,000, excuse me, on that, worth about $3.8 trillion. And the magic numbers are two. One of them is 40% of those companies have been held for more than 5 years as of the end of 2025, which means it's time to sell. That's 40%. That's a big number out of 32,000. And that the average holding period for deals that were exited in 2025 was 7 years. Well, that means when you think about it, that deal was done in 2018. And when you look at the liquidity issues, most people think, well, this is all to do with the 2021 spike in deals. And it really isn't, because in 2025, those deals were only 4 years old. So those are not considered, aging deals. They're getting close to the time where you want to pull the trigger on exit. But most of this exit overhang, these 40% of companies, were deals done in 2017, 2018, and 2019, which means pre-global pandemic, pre-inflation surge, pre-interest rate surge, pre-tariffs and other macro issues. And so if you're an LP and you're looking at these 40% of companies, you're saying to yourself, well, what are these things worth? I mean, I know they're marked at something, and I know that's probably a pretty good number in a lot of instances, but that's a heck of a lot that's happened since this deal has been done. And I still haven't seen my liquidity coming back in the form of DPI. So do I really trust what it's worth? Until I see the capital, the more years that go by, the more challenging it becomes for LPs to actually trust a number. And we're now seeing that we're kind of in this fifth year of a grinding of the gears of net distribution and DPI being below expectation. And of course, a lot of GPs will want to come back to market and raise. And the tension is, if you're an LP and you haven't shown me the money, it's hard to trust your model is actually working until I see some of that. And if you're a GP and you haven't quite reached where you want to in terms of your valuation mark in order to exit, you want that extra year to build EBITDA and build value so you don't disappoint your LP. And I think those two things are coming to a head, Troy. That's the issue where we are right now, is that it's gone on long enough that LPs are saying, certainly in the rooms that I've been in, and in the digital polls and raise of hand polls with LPs and GPs in the room, the LPs are kind of like, okay, we're kind of had enough of this now, and we need to actually see a more measured liquidation plan so we really understand what we're dealing with.
Well, I'm curious to talk about a few of the things that are impacting the market today. One of the things we keep hearing about is the K-shaped economy, and people are now applying this metaphor to deals. Can you talk about what that means in the context of private equity transactions in terms of the haves and have-nots, and how is that impacting middle market deal flow?
Yes, I mean, we at Bain are using that exact phrase, the K-shaped recovery for private markets, and it is, literally a tale of two extremes. If you are an investor that's been putting back a lot of capital, and there are those investors that have been doing that successfully over the last few years, you're able to raise literally whatever you want to raise in a very short time frame. That is a minority of the funds. It's not a majority of the funds. There are also those mega funds that have performed reasonably well with very large alternative asset firms backing them that are in the professional fundraising business, right? They have the kinds of resources where they can raise lots of money from sovereign wealth funds because they're big enough. They can raise money from individuals. They can raise money from all kinds of institutions. So they have the resources as long as their performance is good enough to be able to raise a lot of money and do a lot of deals. If you're a specialized fund and you're an alpha generator, you also have that ability because you're putting DPI back at a very high IRR and you can raise what you want. Where you don't want to be is if you're not one of those two things. If you're not one of those two things, if you're a classic generalist fund who maybe invests across a number of sectors the way you have for 20, 30, 40 years, some of these, and done pretty well, but your DPI happens to be low, or you made a mistake on a deal and lost some money, those are the kinds of firms where the market is beginning to question whether or not the business model is fit for purpose for the next 5 or 10 years. Like, can they really reliably generate alpha? If I can't understand it in 3 or 4 bullet points and I'm an LP and I haven't seen the money in a few years, I'm very concerned. And you don't have the scale to actually bring all the resources imaginable to fix a deal if it's gone wrong. And you don't have the scale to be out there raising all kinds of money because you've just generated so much in fees, you can actually manage to pull that off. So you're not big enough to withstand a lot of things and survive anything. You're not differentiated enough in a way that I can understand to make me believe that you're going to be a winner over the next 5 or 10 years, definitely. And I haven't seen the cash, so I'm worried. So that, hence the K shape. That is the bottom leg of the K and the part of the market that folks are worried about. Now, I was on a panel at a industry conference just 2 weeks ago, and I was asking the panel, who were all run GPs, say, tell me a little bit, about what you think about GPs not re-raising or zombie funds or whatever you want to describe it. And I threw out there that a good measuring stick would be something like the GFC, where 1 in 5 funds did not re-raise after the GFC. Now, during any period of time, whether it's good times or bad times, there are GPs that don't re-raise because people retire or a key man leaves and forms their own fund. So things happen, but 1 in 5 is a pretty big number. And I threw it out to the panel and said, well, what do you think? Is it possible that 20% of the GPs might not re-raise? And one of the panelists said, not 20, 40. 40% with $1 trillion worth of those assets that they have under management, and it's a big problem. So that was one GP's opinion, but it was pretty authoritatively stated. So I don't know what the number is, Troy, but somewhere perhaps between 20 and 40% of GPs are caught in this conundrum and may have a big difficulty in raising their next fund.
Wow. Well, Hugh, I've also heard the K-shaped analogy used for deal activity today, where funds are able to get liquidity on their absolute A+ assets, but that below that, there may be no bid. And for whatever reason, people don't seem to be pricing risk in the way that they did in the past. Is that what you're seeing, and why do you think that is?
I think that's very true. We're seeing continuation vehicles, which by definition, LPs feel like, well, that has to be the best asset in your portfolio, right? Or one of the best assets, or else you wouldn't be able to finance it for another 5 years. Very few assets have a decade or so long duration and the ability to compound value for that period of time. And so if you circle the continuation vehicles as an example of that, that would be an example of some of the best assets in an LP's mind in the portfolio being brought to market. Obviously, as I've told you, in markets like the United States, pricing continued to go up in 2025. It did not come down, which suggests, again, only the highest quality assets that people feel are absolutely going to trade at a very good number are being brought for complete sales. And so, again, if you're an LP, what you're worried about is, well, that would mean that the net return of everything else you're holding in your portfolio is going to be lower because the best assets are either being sold in their entirety or they're being put into continuation vehicles or in some way partially monetized. So mathematically, doesn't that mean my returns are going to be lower when I look at the rest of the portfolio? That is the fear. And of course, GPs are saying that's not what's actually happening. But until we see the money at whatever rate of return that we're going to see it at, that's the problem. And I was at recently another conference where I asked a question to just the GPs and LPs in the audience. And I asked, what is the problem with exiting assets? And the number one answer by a wide margin to that problem is that sellers will not sell below their marks. And if that's the case, that would be indicative that we have a pricing issue, which, Troy, again, would not be a big surprise, right? Because the one thing we haven't had in all of this cavalcade of large disruptions to the market that we've been discussing over the last 5 or 6 years is a big recession. And without a big recession, the stock market doesn't drop 20 or 30 or 40%, and you don't have reasons to mark things down. And so with private multiples, as we've just discussed, trading near all-time highs because only the best things are getting sold, and the stock market still near an all-time high despite the recent volatility, where do you look for things that give you reasons to mark things down? In 2008, in the third quarter, the entire industry took a big markdown because it was clear we were entering a major recession and big problems were to be had in the banking industry and in the housing markets. We don't have any of that. And yet it's not clear with all of these macro gyrations that we've been through that these assets are worth what they're marked at. And I think that's the biggest LP concern. And it's also the biggest GP challenge to be able to deliver on those marks.
Maybe put yourself in the shoes of the LP community. I know you talk to those folks often as well. Historically, we've had a very consistent recycling of capital. Funds are getting distributions, they're feeding that back into the industry. As distributions slow down, how is that impacting from a macro level LP allocation decisions? And when does that really just start to affect the whole industry's ability to raise capital?
It's a fascinating topic, Troy, and it's one with immense debate. If you look at the average distribution as a percent of paid in capital for the last 4 years, it's been less than 14%. And that implies something like an 8-year capital recycling model. There is no LP that I know that has a spreadsheet with an 8-year capital recycling model. 4 years, yes. 8 years, no. And the fact that we've had this 4 years in a row is completely unprecedented. During the GFC, that number was 2 years in a row where we had really bad liquidity, and then it bounced right back into a normative range of 20 to 30% of NAV a year. We're still under 14 for the fourth straight year through 2025. And so LPs are becoming concerned. And I already mentioned another number which compounds this problem, and that is there's $1.3 trillion worth of dry powder out there that hasn't been called yet. But it can be called at any time, and the LPs have to write the checks. So if you look at the amount of liquidity that we've seen and another 1.3 trillion on call, the LPs begin to worry about, well, how much more can I actually commit to this asset class and where am I? So that's the worry side. And yet you don't see a lot of LPs announcing we're taking our allocation to private equity or buyouts, that part of private equity, down dramatically. And why is that? Well, if you look at some of the alternatives, public markets, for example, you are generating wonderful returns if you've been investing in, say, the S&P 500 over the last 10 years. But the challenge is that a big chunk of those returns are resting on the backs of 7 stocks. And if I just look at 2025 as an example, the so-called Magnificent Seven generated 40% of the returns of the S&P 500 index in 2025. And if I add 10 more stocks, I get 75% of the returns. So investors are very aware that while public markets like the US are doing great, it rests on very narrow shoulders. And if anything happens to that tech space or some of those companies, then those returns are going to drop dramatically. So private equity is being used for diversification purposes at substantially attractive returns as much as anything else. You want something else. I love the public markets. They're great, but they're narrower than ever. And I need to go broader in order to actually diversify my risk and feel good about the returns. So that's the push-pull. There are other areas of the private markets where we're seeing a lot of growth as well. Obviously, secondary markets, because that helps provide liquidity, infrastructure, particularly the digital infrastructure play as a way to play in a different way, the entire AI wave. So other areas, private credit has been very popular. So we've seen the growth in other areas, but I think we continue to see major allocations stay flat at a minimum in the buyout space because of this issue as to where do I exactly put the money. There are other private asset classes, but public feels kind of risky to keep betting that we're going to have record returns year after year after year on the backs of very few stocks.
So allocations are staying relatively consistent to historical trends to the asset class generally.
That's what we're seeing. Now, obviously, there are individual LPs that are taking their allocations down a little bit. Some others may be going up a little bit, but there's no huge movement that we've seen yet. Yes, meaning it's certainly possible in the future of allocations trending downward.
That's super interesting. So our Q1 26 forecast, based on our deal volume, shows that volume is within 5% of last year. One of the things I've been curious about as I'm talking to our investment banking customers is is NDA volume going to hold as a predictor of transaction volumes? And the reason I'm curious about that is one of the things I keep hearing is that there's an increased number of broken deals, and bankers are having to go out to more buyers to try to get a deal done. I haven't
Yeah.
seen any data on these particular topics, but I'm curious what you're seeing on the ground today and if that rings true with you.
No, I think your NDA index for the first quarter is accurate from all the data sources that we see, that it is a predictor that the market is kind of plus or minus doing okay versus last year. It's certainly not growing rapidly versus last year. It's certainly not in a big decline versus last year. There are some concerns about the software space. I think the pace of NDAs historically has been a good long-term predictor of where the market is going to go. Where you get into some challenges is if you get something that's completely unexpected, that is a black swan event that happens immediately and simply shuts down the deal markets over time. So you have to be careful to watch for a large macro event. But what we're seeing right now is a reasonably healthy deal market, but without huge expectations that we're either going to grow drastically off of 2025 or decline dramatically off of 2025.
Well, let's talk about the valuation standoff that you referenced earlier. You made the point about there's a difference between public market comparables and what's actually inside PE portfolios and what things are trading for in the private markets. Can you unpack that a little bit and talk about how that's impacting deals getting done?
Sure. So if you were to look at, say, the GICS code for information technology, which is a very popular one. If you're looking at information technology in the private markets, about 90% of what's in that code is software businesses. Not just software, but B2B software tends to be necessary, could be government software, but things where they're required, they automate things, nobody's ever going to turn them off, and they can be underwritten with some debt underneath it. Very little would be hardware. If I look at the same information technology sector on the public side, 40 or 50% of it are things like Apple. They're hardware, lots of hardware. We don't see that in the private markets. And of the software types of businesses, again, you don't see those types of software businesses, B2C, big B2C software businesses in the private market. So even when you look at the same sector, quote unquote, the kinds of targets, the kinds of companies that private equity firms are buying are not the same types of businesses that are in the public markets. And so as an investor, when you look at that and say, oh, well, this sector isn't even, yes, it's technology, and yes, but the mix is different. The kind of software businesses are different. And so I need some of that for some diversification purposes. And therefore I want to lean into that and buy that. And I want it at good return. So obviously private equity is an actively managed asset class. There is no index, there is no passive ETF. And so I need to partner with the smartest managers that are buying those kinds of things that I can't replicate anywhere else and generating really good returns.
Well, you have described this year as a watershed year, I think, in some of the Bain content. What has to happen in 2026 for this logjam to actually break and to see these portfolios actually start to sell and for DPI to trend in the direction that LPs want to see?
I think one of two things have to happen, Troy, and probably both of them need to happen. One is that some of these portfolio companies that are a little older need to hit their EBITDA targets that allow them to exit at a reasonable multiple in the GP's mind. And the second is we are going to see, plus minus with that, we are going to see, I believe, or need to see things being exited at marks that may be below the current mark in the portfolio. And if it's a little bit below, I think that's fine. If the returns are obviously not good at all, then that's a totally different issue. But we cannot, if you're a fund, if you're a GP and you want to raise, and 30% of funds pre-2020 have not raised again, which means they're basically done with their investment period. They're done with any extensions that they have. So it's time to go back to market and raise a new fund. So 30% of every GP that's out there is in this box. They have got to deliver liquidity to their LP community this year in a way that gives them confidence and trust that they should be raising another fund. And I think that's the big challenge. That's the thing to watch for, is like, where are these exits coming from? Are we starting to see exits that are below the intrinsic marks that were made in the last quarter? If it's marked at 2.5 times and you sell it at 2.25 times, most LPs say, I understand that. That's okay. I'll take the return. I'll take the. Now, if it's a very different number than that, then there may be other issues. But those are the kinds of things that we're looking for, are real exits. That's what LPs have told us they want. We don't want to see more continuation vehicles. We don't want to see NAV loans. We don't want to see dividend recaps and partial stake sales. We want to see traditional exits from the market. That can be IPO, that can be sale to a strategic buyer, that can be sale to another sponsor. But let's go back to what we're normally have done in this industry for decades. Show me that the returns are okay, and then we can have a discussion about the next fundraise.
I've heard mixed things from the LP community about how they view continuation vehicles. What is the discussion around continuation vehicles? How sustainable do you think that mechanism is? And to the extent people sort of throw their hands up and say, hey, we don't want this anymore, what causes that to happen?
I mean, there's a bit of consternation about continuation vehicles. There's certainly an economic case that these are fine, right? If I can tell you and convince you as an investor that these assets are actually tremendous and they can continue compounding for years and years and years, and you actually have the ability to either re-up and invest or cash out as you like, that sounds like a reasonable proposition. The problem is, number one, there are a huge number of CVs out there for LPs. Some LPs are getting one CV a week crossing their desk. It is almost impossible to do new due diligence on a deal a week like that with everything else. That's in addition to your day job as an LP. So the flow is heavy. And for that reason, a lot of LPs tick the liquidity box because they can't possibly underwrite it and don't have the resources to do it in the time necessary when you've got that kind of a flow crossing your desk. So a lot of LPs, and Jen Choi, who runs ILPA, told me this in a recent podcast that she and I did, they would like to have a status quo option. Well, why do I have to cash out, or I have to re-up at a new valuation that I'm not sure I've had time to check, and I haven't had time to check, and take the run for the next few years? Why can't I just stay in the deal at the current rate? That's not an option. I'd like that to be an option. So I think many LPs feel like the flow is heavy. It's a tremendous burden on them. They feel like they don't really have much of an option but to check the box and take the liquidity because they don't have time to look at it. And they wish they did have more options. And there's a bit of a concern as to sort of what is in these continuation vehicles. And I think continuation vehicles, as I said, they do have an economic rationale. They do have a place. They are not a panacea for liquidity because not that many companies can compound for 8 to 10 years consistently and deliver value and good exits twice in that period. Certainly some can, but I wouldn't say any of us would argue that's the majority of companies that are being held in portfolios. And we would estimate at Bain that, less than 10% of all liquidity events were CVs in 2025. So there's a lot of noise, but in actuality, the liquidity being provided is a bit less than that. And yet, for a typical LP, you might see 50 of these cross your desk in a year. That's an awful lot in addition to your day job.
Yeah, you touched on something that I've been curious about, which is how are LPs managing this and processing this just from a staffing and capability perspective? Historically, most of these LPs are asset allocators. They pick managers and they pick funds. And now they're being asked, as you suggest, in very high volume to underwrite particular companies or particular assets. Are they changing the way that they're investing and staffing their teams to manage this?
I'm not sure enough time has passed to really have that happen, Troy, or happen at scale. A lot of LPs are on pretty tight budgets. They kind of have what they have, and they, as you've mentioned, they're asset allocators, and they run that way. Some LPs do not even co-invest and don't have the resources available to do that, or they do it very programmatically and get a quick recommendation from a consultant and do not spend a lot of time themselves because they don't have the capability and the bandwidth to actually look at it. So to layer CVs on top of that, I think the question that one needs to ask in the industry is like, how long lived is this going to be? What are the returns for CVs going to look like really? Because GP-leds have really only been around for 10 or 12 years, and they've kind of only been at scale for the last 3 to 4 years. So we haven't really seen enough of this movie to even know how it's going to pan out. So do I need extra staff? Should I put more people on? How should I handle it? I think those questions are still being asked inside of many LPs. And yet we have this flood of opportunities, if you will, for CVs crossing the different desks that all need to be dealt with. And I think that's why you have this almost dichotomy, right? You keep hearing this buzz in the market that, gee, a lot of LPs don't like CVs, but I've seen some of the stats. I can't remember the exact number of that, but 96% of the cash was cashed out in the CV. And you say, well, if they don't like it, why is 96% of the cash coming out? It's because they don't have time to look at it. And so therefore the reinvest motion seems much riskier than the take my cash at whatever return I got and take it off the table motion because I don't have the time or the resources to look at it.
Right. That's interesting. Well, earlier you talked about, we had this decade of really unprecedented elements in the environment surrounding private equity, and that you view a lot of this as just the maturation of the industry. Maybe at a high level, what are the key elements of the mature industry relative to the industry 10, 20 years ago? What do you think the big differences are going to be in how firms operate in the ecosystem generally?
It's a great question, Troy. I mean, for most of the 35 years or so that I've been kicking around this industry, it's been kind of I'll call it a cottage industry, but everyone could win. If you had your LPs and you knew what deals you wanted, that you could buy at the right price, and you had some talented folks, there was enough room for everybody to win. And we're now in a situation where that's no longer true. That defines a mature industry. There is not enough opportunity and excess profit for everyone to actually win. And when you look at what's happened in the industry, it's kind of been masked, as I described over time. It's a couple of broad trends that show the maturity and the need for what I'll argue is a real strategy for the first time. The first thing is that the cost of generating alpha is going up. The cost of things like sector expertise, technology and AI, post-close value creation ecosystems, sourcing, processing deals, all of those costs are generally speaking up over time because it now costs more. We don't need, when I started in this industry, you needed a Rolodex and a telephone to do a deal. And then you needed to know how to talk to a bank. And you bought something at 5 or 6 times cash flow. And as long as it didn't die in 5 years, you made a pretty good return. Well, now with things trading at 12 or 13 or 14 times EBITDA or more, all that margin for error is gone. And everything is intermediated now. There's no proprietary deals. And all of the financing is staple financing that's also commoditized. So a lot of the things that were advantages 30 years ago, if you knew people, aren't there anymore. There's commodities for everyone. And so in order to get ahead, you've got to have better ideas, and you've got to be able to really underwrite those ideas with confidence. And that costs money. So costs are going up for the average GP in order to generate good returns. And at the same time, what fewer people talk about is that fees per dollar of AUM have been dropping in this industry for the last 15 years, both in terms of headline fees, which have dropped from about 2% down to about 1.6 on average. And that's scale adjusted. The biggest funds are obviously going to be lower. And if you're a very small fund, you're still going to be charging close to 2% because you need those fees in order to operate as a business. But still, it's the first time we've seen a meaningful trend down in management fees for the industry overall in ever. And then secondly, and an even bigger impact is the impact of co-invest. Now, go back to 2010, co-invest was like a hobby. Some LPs liked it a little bit, most didn't. It was really not a thing at all. Our latest survey estimates and a survey we put together with Stepstone that talked to over 100 GPs would suggest that 33 cents out of every dollar that's committed to a fund is actually put aside for co-invest. That means 33 cents out of every dollar probably doesn't have economics attached to it, and yet the GPs have to manage it. Well, if you do that year after year after year, your dollars per AUM go down pretty substantially over time. And of course, there's a wide variance in that as a GP, and you've got some fee pressure, and your costs are going up. That means margins are under pressure. Now, that sounds like it's something to be scared of. This is what's called a mature industry. This is what happens. It costs more to do better. It costs more to differentiate yourself. It's harder to charge high prices. I mean, that's what a mature industry is. And it doesn't imply that there's anything wrong with the industry or that it's going away. What it implies is you damn well better have a good strategy that's repeatable to generate alpha over time and be able to not only just explain it to your limited partners, but actually do it and say, these 8 deals prove that I can do this repeatably. Or you're going to have a great deal of difficulty, number one, delivering those returns, and number two, being able to raise money to continue to do so.
Yeah, a lot is changing.
Sure is.
Ontra provides technology and AI to private equity firms, and I know your firm is one of the most important advisors to funds about how they scale and operate as a business themselves. So I can't not ask you about AI. You've mentioned, I think in past reports and in podcasts, that the PE firms have been spending a lot of time asking, what does AI and the changing technology landscape mean for my portfolio? But one of the things we talk to the industry about a lot is, how does this change the investment process and how a fund operates? What's your perspective on how the business model is changing and evolving due to the adoption and changing landscape of technology capabilities?
It's a great question, and the answer is, we're in about, if I can use a baseball analogy, we're in about the second inning of a 9 inning game here. So a lot of folks are experimenting with AI. A lot of folks are using it, particularly in the portfolio, and seeing some benefits, but this really hasn't transformed the investment process yet in the way that it should. AI and AI tools should allow you to source more efficiently. We're moving from a world where, because of specialization, because of the need to generate alpha, I'm not having 1,000 sims come in the door every single year and then picking out through a long process which 2 or 3 I might buy. That's sort of the old way of doing business. Now it's, I want to proactively go out and build my deal pipeline. I want to understand what companies I want to own maybe years before they're even sold, and why I want to own them and why they fit what I do. And then when they do come to market, I'm able to move faster with greater confidence than anybody else. And I'm able to pay the number because I know I can get the value, because I understand what this asset does, and I understand how I can use my playbook in partnership with management to create value. So there's an inversion of sourcing going on. I had a secondaries GP tell me, an LP secondaries GP tell me, I used to not be able to write a check below a certain number in sourcing because it would be economically inefficient given the size of my firm to do so. But using AI, I can now look at any deal of any size and evaluate it. So the bottom part of the market, which often has some bigger discounts and interesting deals in there, is now available to me in a cost-efficient way that it just wasn't before. So we're beginning to see harbingers of things like sourcing, or in underwriting, the ability to process intelligently large amounts of information incredibly rapidly and get to a point faster with more confidence than we were in the past. There are still other things to look at. It is not magic, but it actually helps catapult you into a different place in your underwriting, especially if you know what you're looking for. If you're one of those alpha generators that say, we have a playbook, we know how to underwrite, we understand exactly what we're looking for. Is it present or not? Are the bad things that have hurt us in the past in terms of capital impairment present or not? What's my confidence interval? Let's move on. So I think a lot of the initial noise was in, and rightly so, was in the portfolio because, gee, I own all of these assets. What the heck is going to happen, right? Is that the light at the end of the tunnel, or is that the oncoming train? I need to figure that out first. But we're now seeing, what about my own business? What about my own investment business? How do I both take AI and technology and use it to my advantage, but how do I also do a little bit about what you do at Ontra? How do I actually get all that quality and gain efficiency and reduce cost at the same time? Because I just talked a lot about the costs are going up for GPs. So they're also looking at AI and technology and other types of services for ways to reduce cost, because they know it's going up over here and that's not ever going to change, or certainly not going to change anytime soon. So where can I find the use of technology to actually make me more efficient, actually make me better at lower cost?
Yeah. Well, you touched on a trend in terms of bigger funds coming down market due to the ability of leveraging technology. That reminds me to ask you about one of the trends that you talk about in your report that has been seemingly accelerating, which are the largest firms are just consolidating more and more capital as a percentage of total capital in the industry. And that's through their LP relationships, but then also through M&A and consolidation. So how does this industry change, and what does it mean for middle market players when you have the largest firms like Blackstone and Apollo and KKR who are raising 20% of the total capital in the hands of just a handful of logos?
Sure. I mean, there's no doubt that the big are going to continue to get bigger as long as they perform. If they do not perform, that trend will start to reverse itself, certainly in the field of buyouts or whatever product it happens to be that isn't performing. I think that if you're an alpha generator, and that, by the way, doesn't mean you're small. There are plenty of firms that are specialized to generate alpha that have over $100 billion of AUM. It doesn't mean you're small, but it means you have a specific set of things that you understand how to underwrite, and then go and get speed to value creation and make sure that that value creation happens post-close. Sometimes it's sector expertise. Sometimes it's what exactly you're underwriting. We do only buy and builds, or we only do carve-outs, or whatever it happens to be. And you can replicate that, and you can show LPs that you actually do that. Some of the players are smaller and more specialized, but some of them are actually quite sizable. The troubling area is when you're neither of those things. Like if you're not one of the big performing players that's able to continue on and consolidate and get bigger and bigger, and you're also not a proven alpha generator, you don't have a repeatable model with moats around it that you can show through deals and you can explain to people, those are the folks that are in danger of either getting consolidated or frankly just going away. And I think that's the the crux of the issue right there. It's like, do you have enough there that people are going to want to buy you because your talent, your subsector expertise, your geography, whatever it happens to be, you've got something that actually is valuable to another GP, and therefore you're a candidate to be consolidated? Or are you so generalized and mistakes were made and we've got a lot of problems that it will probably be the shakeout of the market that you won't re-raise again? But I do think we're going to continue to see a bifurcation of the market. The big that do well will continue to get bigger. They can't absorb all the world's capital that wants to invest in private equity. So I do believe that the middle market will continue to be attractive. I just believe it's got to be a lot more specialized than it is today. Like folks that used to do 5 different things in very different sectors, that's probably going to be hard to do versus 1 sector, 2 sectors, 3 sectors, or a number of subsectors across those with a certain angle. It's just more specialization is required in order to generate returns, because we have plenty of everything, Troy. We have plenty of money, plenty of debt. I made all of those points earlier. What we need are ideas. And in order to get the clever ideas that are going to generate value, you have to really know a lot more about what you're investing in and how it behaves in different economic times and in its microclimate.
Yeah. Well, speaking of plenty of money, we talked about how institutional LPs are holding allocations steady. And my understanding is, depending on how you slice it, institutions allocate between 30 and 50% to alternatives broadly. But about half of global net worth is in the hands of individuals. And one of the things that the industry is talking a lot about is the private wealth channel, where I understand roughly 1 to 3% of total private wealth capital is allocated to alternatives today. And so you do some basic math. If private wealth starts to look anything like institutional allocations, that could unlock a tremendous amount of fundraising for the industry. Is this actually happening, or is it mostly aspiration, and why?
It's happening. It's just happening, I think, a little more slowly than folks would. Some folks would like, but I think it's going to happen. And usually, in my experience, things happen when everybody's incented to have them happen. And we've talked a little bit about this, about some of these elements earlier. Individuals, like institutions, like the idea of diversification at high returns that private assets can provide. Their investment advisors also like that and are telling them you need diversification and you need to actually have exposure to private markets. So this is a good thing. The product providers, the alternative investors who have the product, they obviously want access to half of the world's capital. We just talked about a lot of liquidity constraints with the other half of the world's capital that they've been chasing for years. So with half the world's wealth basically not really allocated at all to private assets, that's a pretty enticing area of white space for the product providers. And then the traditional asset managers are also looking at this. BlackRock owns over $600 billion of private assets. They're one of the top players in the world of private assets just all on their own. So the BlackRocks, the Fidelities, and the Vanguards are looking and saying, well, I could continue to charge 7 basis points for that ETF, or maybe I could charge 100 basis points for a private credit product or 300 basis points for a private equity product. I'm making up numbers, but they're all going to be a lot bigger than 7 basis points. And I have relationships with all these individuals that everybody's trying to actually get after over time. So when everybody has an incentive here to figure out how to make this work, at least to some degree. And obviously private assets at scale aren't right for everyone. But if you just make very small assumptions, I mean, if you just say 5% of that, private individual money, private wealth finds its way into private markets, we're talking about trillions and trillions and trillions of dollars. That is a very material amount to go into the asset class. And there are already almost a couple of hundred evergreen funds out there that are allowing individuals in. And some of these funds, as little as a couple of $1,000s, you can write a check. And many of them are 40 Act compliant now. And so it looks and feels like buying a mutual fund. You're not doing a commitment and then a drawdown over time. You're putting in the money now that you want to put in. You get a 1099 at the end of the year. You don't get a K1 and a lot of complicated accounting forms to figure out your taxes. And so these products already exist. It's a question of, there are lots of things, right? There are regulatory questions, there are valuation questions, there are transparency and reporting questions, but these are solvable. Like these are not all things that are going to be impossible to solve. They're going to be solvable at a certain time. And I think we're seeing, starting with the after-tax market, we're seeing a lot of these products come out there. And whether we get to 401ks, we'll sort of figure that out. But obviously, defined benefit plans are already in pension plans around the states if they're defined benefits. So defined contribution will probably come at some point. So I think the train has left the station, Troy. It's just a question of how fast it's going to get up to full speed.
Yeah. Well, Hugh, I want to respect your time. Maybe to cap things off, when you zoom all the way out, is 2026 going to be the year that private markets finally turns the corner? Or are we in for a bit more of the same?
Ah, Troy, I so desperately want to say yes to that question. It's like your Groundhog Day. It's January again, and I feel really great and really excited the way you do that we're going to continue to sort of see the industry explode with growth. And I, I think the industry, except for this liquidity issue that we talked a lot about, the industry broadly is doing fine. I think the velocity of deals, absent a black swan event, is going to increase a bit this year. I don't think it's going to increase 20 or 30 or 40%, but I think we could see a 5 or 10 or 15% increase in velocity in terms of the number of deals done, which would be terrific. I think if we saw something similar on the exit side, that would be wonderful. Something in terms of double-digit growth. So I'm a glass half full guy. I'm an optimist. That's what I'm still going for. I know there are some worries out there in the marketplace and some reasons to actually pause, but it's still first quarter, so I'm going to be glass half full.
Good. We'd all love to see it. Well, Hugh, this has been a ton of fun. You have a really unique ability to make complex dynamics digestible and actionable. And before I let everyone go, I just want to mention the Ontra Market Index Report is available now. You can download it at ontra.ai. And if you want to go deeper on Bain's view of the market, Hugh and his team just published their now infamous must-read, their annual Global Private Equity Report, which you can find at bain.com. And if you are curious about what Ontra does and how we're helping GPs work smarter with AI, reach out to us. We would love to show you what's possible. So Hugh, thank you for the time, and thank everyone for joining us. This was a lot of fun.